length. Both you and I have interviewed Judy and Shelton, and she said he's going to back the back end of the Treasury market with gold. My thesis, in essence, is gold's revaluation higher, whether it be organically for a long time, as Luke Groman says, it will get to 6,000 or 7,000. You're watching massive stress in London. There are reports that there's genuine stress for silver, lack of silver in China, that the supply chain has completely been dried. For the first time in 50 plus years, central banks not only are buying gold, they're buying silver too. We saw Saudi central bank purchase almost 30 million worth of SLV in August. As much as I almost choke on saying that, SLV, the amount that they bought would allow them to take possession. And then you get reports that foreign investors now hold a higher amount of gold than U.S. Treasuries. In fact, the share of U.S. Treasuries, they were saying, was down by foreign investors from 49% to 31% today.
Judy Shelton has proposed that the U.S. issue long-term Treasury bonds backed by or convertible into gold to restore trust in the dollar and strengthen U.S. debt credibility. For the first time since 1996, foreign central banks now hold more gold than U.S. Treasuries, marking a major shift in global reserves. If Shelton's gold-backed Treasury plan is adopted, it could lower borrowing costs and anchor the dollar to hard assets. Analysts believe a formal gold revaluation could send prices towards $6,000 to $7,000 an ounce. Meanwhile, London's silver market is under severe strain, with shortages spreading to China. Central banks are now accumulating both gold and silver, signaling a diversification away from paper assets. Saudi Arabia's central bank notably bought 932,000 SLV ETF shares and over 200,000 SIL ETF shares in 2025. This trend highlights a growing global move toward tangible reserves and away from U.S. debt reliance. Andy, the president and CEO of Miles Franklin Precious Metals, a leading U.S. bullion dealer, points out that the tight physical markets, high lease rates, and cross-region metal movements show real strain in gold and silver supply. Persistent backwardation in silver signals distrust in future delivery and extreme demand for immediate metal. Ultimately, this is less about short-term price swings and more about a global revaluation of fiat currencies against real assets like gold and silver. The markets are always shifting. Don't fall behind. To keep ahead of the curve, subscribe and like this video. Please leave your comments in the space provided below. We would be very grateful to hear from you.
To me, the bottom line is that the theme that we've been talking about, the tight physical, the high lease rates, the cross-region scouring for bars, this is real and well reported. And if you see 150 million tons from Chinese state banks and via the Shanghai Gold Exchange delivered to London to quell this problem, it would go hand in hand with knocking the hell out of the price by the same players to make people think the market is overvalued, that it's at its peak like it was in 1980 and 2011. And look, letting the price go up as high as it did pulled in an awful lot of speculators, and a lot of them didn't own gold; they just owned paper. And so when you dump massive waves of futures contracts into this thinly traded market, a lot of them sold without even knowing. They got triggered out of their contracts, which drove the paper price down. And maybe that's when you had London come in and say, we need to buy this silver at a lower price. Maybe it was London who came in and bought that silver after they knocked it down. I don't know who did it and who bought it. But I do know is that, to me, the whole point was to scare people away from buying gold and silver. That's what it really feels like to me. And this wasn't just another random correction. To me, it's as much as it could be as big as helping keep the LBMA propped up to maintain their system. But if there really is that much of a shortage that we've been hearing about forever, this game can't last, and supplies will keep shrinking no matter what amount of paper selling comes into the market at inopportune hours. And so I think, again, yes, it's scary to see a market move like this, but the fact that it moved like this is what, to me, makes it not so scary. It just reeks of desperation by big players who have been caught in a game where no one ever stood for delivery and a continual rotation of paper promises has been what has allowed the fixing of gold and silver by the West forever. And it is now being challenged. Not just gold and silver, all of the world's commodities are being bought. And when we see 21 days of backwardation, where the normal market is called contango, where the price is for the future, or the spot contract is lower than the futures contract. When you go out into time, you have the cost of storage and interest and the time value cost of money. That's normal market. Backwardation says, I don't really want to trust you next month or the month after. I want it now, and I'm actually going to pay more for it right here today than I will out into the future, because I really don't trust the future. And to see that in silver is really unusual. And for as long as we did, and as much as $3, now it's narrowed. But what I'm saying is that is really very bullish. And when you see this kind of desperation, knock the hell out of the price and then gobble silver up to where it goes green in 20 minutes, someone came in and bought physical. And maybe that was the trade. Maybe what Eric Young is saying happened right then and there, that China leased the gold at that level, sold the gold to London to bridge the gap at a huge rate of borrowing. I don't know, but all I can tell you is that it is not what one would expect to see in a normal market behavior, not even close to it, unless you want to be guaranteed the worst possible settlement for your huge trade that you dump just like that at the worst possible time. I mean, I think it all boils down to a breakdown in confidence in the dollar, Michelle, as a reliable store of value. It's like a melting ice cube. The trust in the dollar, the trust in things like the Bureau of Labor Statistics or the CFTC. The CFTC, if you ask most people who were watching the JP Morgan trial when they did pay a $920 million fine to the Justice Department for spoofing, that it should have been RICO charges, that it should have been much more severe than it was, that the CFTC hasn't done anything to protect the gold and silver market. Trust in the dollar, trust in our institutions, trust in everything is fueling. This is what has been fueling higher commodity prices, tighter credit spreads. Real assets like gold and silver are stepping in to capture what the dollar and the loss of trust is losing. And I think when trust in the dollar starts to slip, and in our institutions and in our reporting of the facts and of reality, people move into real assets like gold and silver. This isn't about price increase in gold that we've been seeing for the past 9 straight weeks. It's about a revaluation of all fiat currencies by gold. And I think that that's really what is happening. And I think it started to arguably start to make people nervous that things needed to I think calm down a little bit. And people are most affected by price. It is the greatest tool of misdirection. They don't look underneath the hood. They just see the price and they listen to the nonsense media. And shame on all of these media talking head geniuses who, on one hand, from an economic perspective or from a market and analytical perspective, are correct. But ignoring how it was achieved is ignoring the most important part of the story. And I think it renders what they're saying moot.
Andy here suggests U.S. policymakers may be allowing gold to rise as a controlled way to devalue the dollar, reduce debt pressure, and revive manufacturing. Gold's surge above $4,000 reflects waning confidence in the dollar and fiscal policy, not just inflation. Sudden paper-driven sell-offs appear to manage optics, keeping the rise orderly. A formal gold revaluation or gold-linked treasuries could unlock hidden asset value and restore monetary stability. Let's get into the details of the interview for further insight.
I think that the idea is to let gold go higher to devalue the dollar, to make, and that's in essence a good portion of the Mar-a-Lago Accord. Stephen Mirren, who's Trump's advisor, now filling the vacated spot at the Fed, to make manufacturing more attractive. And if we take Judy's part, backing the long end of the Treasury market with gold, you can bring back manufacturing with no upfront borrowing costs. You have to redeem it in gold in 20 years, fine. So let it go higher. But in the meantime, you bring back your manufacturing at very, very low, if not zero, upfront borrowing costs, redeemable in gold later, and you use the continual synthetic accumulation of gold through the Genius Act and the Treasury purchases. When you spend those stable coins, they're burnt, they're gone. But the interest on the Treasury is not. Tether gets to make all that money, and they are required to buy more Treasuries to continue to suppress rates and buy those commodities. That's the part that no one's talking about. Buy gold, buy Bitcoin, use Bitcoin to pay off the debt. That's my opinion, and don't know if it's true or not. And use gold to continue to devalue the dollar to make your selling of products around the world attractive. In essence, you're defaulting on the reserve status. Griffin's dilemma. We've talked about the dollar going up 5%. It was down 11%, and he says it's only 6%, and yet gold continued to rally for 9 straight weeks in the face of a strengthening dollar. You look at gold up fourfold higher than the S&P 500 in the face of the biggest tech boom since the internet inception with AI. And you know what the craziest part of it all is that Tether, which is building the machine that will force people into treasury bills, what are they doing with their own money? They've already bought almost 9 billion worth of gold in Swiss vaults. They're buying gold mining companies. They made 13 billion in profit last year, and they're converting it into hard assets as fast as they can. That's part of the debasement trade. That's part of the Genius Act. This is part of the broader thing, is that you're right. These are all, he's right. There are more buyers than sellers. And when you see it in the face of a strengthening dollar, I think it says a lot about gold. These are the things perhaps woke up the powers that be to maybe let things cool down a little bit by dumping metal in the middle of the night when no one was buying it. Vince Lancy, I was listening to his morning podcast, and he said, debasing the dollar before manufacturing is built doesn't really do anything except help us with the deficit. It hurts the economy, and you have to have the manufacturing here before you debase the dollar. Maybe that started to get ahead of itself. You look at gold, which, you can go back and look at how many ounces, how many hours a person has to work to buy an ounce of gold, and it's at its highest level ever. It's doubled in the last 18 months, and meaning gold is outpacing everything. It's outpacing the rise in wages. It's moving too fast. It's catching too much attention. And when you hear reports in the mainstream that foreign investors now hold higher amounts of gold than U.S. Treasuries, and that it's down to 31% from 49% a decade ago, yeah, I think it certainly maybe is moving a little too far too fast, or at least catching too much attention at an inopportune time for the U.S., who is trying to do something. But ultimately, I think higher gold is what they want, not to make gold higher, but to continue to debase the dollar. I do believe that. I just think that there's a lot of moving parts at hand that could accelerate things too quickly with the fragility of the system, in particular, the fragility of the banking system. And maybe it's just gotten a little ahead of itself in terms of what they're planning. Terry, I'm talking about Fed Chairman Powell, and he was just at a conference recently, and he was being asked by the moderators, and she said, "Look, this is an audience question, and it's one that everyone wants to know. Would you care to comment on the price of gold?" And his answer was, "No, I would not like to comment on the price of gold." He completely brushed it aside. And so look, rising gold has implications, and implications for the United States, implications for the dollar, implications globally. So I think that there's a lot more to it than just what the mainstream is trying to talk about. You sent me an article today that talked about the gold prices fell by 5.7% and making it the largest one-day drop in since 2013, and they call it a 4.5 sigma move. In other words, such a large move happens in one out of only 240,000 days in a normal world. What we saw in that kind of a drop is highly unusual. And when you realize it was dumped at the most inopportune time to create this type of sigma event, it starts to reek of desperation of creating a narrative where all of a sudden the one that you speak of, where everyone from Reuters to the New York Post is talking about gold, maybe things are moving a little too fast for the big players, some of which who are still trapped in short positions that represent all but an existential threat to their survival if things get too far out of hand.
What do you think? Could Judy Shelton's proposal to issue gold-backed treasuries signal the beginning of a global monetary reset? As physical shortages and backwardation deepen in gold and silver markets, are Western institutions losing control over paper pricing? If you appreciate this video, please hit the bell button for timely updates, subscribe to the channel, and like the video. Also, leave a remark with your ideas. We value your presence and thank you for your support.